Using financial data, Sven Lerner from Stanford University.
Well, there we go. So I'd like to start by thanking our hosts for hosting this wonderful conference. We very much appreciate being included in the program. So as mentioned, my name is Sven Lerner. I'm a PhD student at the AFT lab at Stanford University. And this is joint work with Svetlana, Bryzgalova, Martin Lettau, and my advisor, Markus, Pelger. And it is called Missing Financial Data. And this is a story about missing firm fundamentals or missing firm characteristics. So firm characteristics are crucial in asset pricing. We use them to construct asset pricing models, such as factor models. We use them to construct investment strategies, such as portfolio sorts or more advanced return-based prediction strategies. Now, we also use them to construct test assets for our models, such as double-sorted portfolios. And as almost everyone who's worked with firm characteristics knows, there's an important problem in that firms have missing characteristics. The question we're asking and trying to answer in this paper is, does missing data matter? And if so, how should we deal with it? You can probably guess by the fact that I'm standing here that we do find that this matters, and the current ways that the literature tends to deal with this issue are highly problematic. So often you'll see authors either choose to use a fully observed subset of data. So if stocks are missing a characteristic, we'll throw them out of the sample. We're going to show that this leads to a massive selection bias. Another option you see people choose is using some sort of ad hoc imputation, commonly with the cross-sectional median. We're going to show that this can lead to severely distorted parameter estimates. So the contributions from this paper are threefold. So first, we're going to document several key stylized facts about missing firm characteristics. Second, we're going to propose a novel method to impute these missing characteristics. And finally, we'll study the implications for asset pricing. And now, well, everything I'm going to be talking about today is going to be through the lens of asset pricing. Firm fundamentals are broadly used also in corporate finance and economics. And with this growing emphasis on big data, especially ESG data and international data, these are exciting new data sets, which are very heavily populated with missing values. So our insights and models will to some degree extend to those data sets as well. Okay, so let's get into the stylized facts. And fact number one, missing data is extremely prevalent. So it affects almost all characteristics and almost all firms. It affects firms which are young and mature, small and large, and profitable and distressed. Now, fact number two is that this missingness is going to become particularly severe when we require that multiple characteristics are observed. So again, if I follow that paradigm and I require that only firms with fully observed characteristics are going to be included in my sample, I'm going to throw away about 70% of the stocks which I have access to. This is going to correspond to around 50% of the market cap, which is huge. And keep in mind, there are a lot of applications like cross-sectional regressions where we require fully observed characteristics. Fact number three is that data is not completely missing at random. So there are systematic patterns in the way that data is missing. For example, we observe clusters in the time series and amongst characteristics when things are missing. More importantly, we see that some for missingness is more common for more extreme realizations of characteristics, and that the missingness depends on the characteristics of stocks. For example, smaller stocks tend to have more missing characteristics. Finally, we show that returns depend on missingness. So to start with, an investment strategy, which is going to use only a subset of the stocks which have fully observed characteristics, is going to lead to suboptimal results. We're going to study two effects of missingness on asset pricing results. The first will be a selection bias, so when we don't include all the stocks that we could. And the second one will be an imputation bias, where we perform some sort of ad hoc imputation, like the cross-sectional median, and we'll see that this will severely distort parameter estimates of interest. We also provide a solution to this problem, and that's a novel method for data imputation. So why is data imputation a challenging problem to begin with? Is it first requires a good model for characteristics to avoid an omitted variable bias. Second, and importantly, the model has to be estimated on partially observed data, but remain valid on the missing data. And this is especially challenging because characteristics are not missing at random. So the method we propose is a cross-sectional and time series factor model for characteristics. So we capture contemporaneous cross-sectional dependency, like the fact that small stocks tend to be value stocks, with a characteristic latent factor model. We'll capture persistency in the characteristics by a time series model. Importantly, this model allows for very general endogenous missing patterns. So missingness can depend on time, stocks, characteristics, and even realizations of the latent factor model itself. And our method is data-driven, transparent, and actually quite simple to implement. Empirically, we provide a comprehensive comparison of our method to competing approaches, and we show that out of sample, we get around a 40 to 50% reduction in the imputation error relative to existing benchmarks. We also show that both the time series and the cross-section information are vital for a good model for data imputation. Finally, we'll be providing the reference data set and the code to perform the imputation so that people can use it in their follow-on. Okay, so let's dig into these stylized facts a little bit more. So the data set we're going to be using is the standard CRISP CompuStat data set. We have 45 of the most popular characteristics in asset pricing. The only thing you really need to take away from this slide is that we're using a very standard data set, the kind of data set many of you have used in your previous research. So how big is my data set? Well, what I'm showing you now in this black line here is the number of stocks I have in my sample at any given point in time. We see that it peaks around 1998 with around 8,000 stocks. Now, if you look at this gray line, what I'm showing you is the number of stocks in my sample for which I have investment information observed over time. You can see that only around 80 to 90% of stocks actually have investment information at any point in time. Furthermore, something like property over assets is going to be missing for about half the stocks in my sample. The takeaway from this is there's substantial heterogeneity in over time and in the cross-section as far as the missingness pattern for different characteristics. Now, again, we come to the elephant in the room. If I require multiple characteristics to be observed, missingness becomes even more severe. So if I want the fully observed subset of my data, so I allow 0 missing characteristics, I'm getting this blue line here. Again, this is more than 70% of the data gone. And that, again, corresponds to about 50% of the market cap. Now, this is not just driven by 1 or 2 characteristics. So I can allow up to 3 characteristics to be missing. They can be different characteristics for different stocks for different points in time. And what I'm going to end up with is this black line here. I'm still throwing away about half the stocks in my sample. I would have to allow about 35 of my 45 characteristics to be missing to end up with a sample that keeps about 97% of the stocks. And again, remember, there's a lot of applications like cross-sectional regressions, which require a fully observed vector of characteristics. So when are characteristics missing? So what I'm showing you here at first is just the missingness for each characteristic in isolation. What you see is that around 10 to 20% is missing for most characteristics. There are some like property over assets, which are particularly severely affected. But what we're also showing you here is that data could be missing at different points in the firm's life cycle. So it can be missing in the beginning, and this can be somewhat mechanical for a young firm which doesn't have much of a history. But it can also be missing at the middle or missing at the end. Importantly, if it's missing in the middle or the end, I have a previous observation for that missing characteristic, which I'll be able to use for imputation. However, if it's missing at the beginning, I don't have access to that information. So our imputation model needs to allow for different information sets. Now, which stocks have missing observations? So what I'm showing you here is the percentage of missing observations by the size of the company. And I'm showing this for all stocks with the black line, or for all characteristics with the black line, and then broken out by characteristics with the other lines. We can see that uniformly, small companies have more missing characteristics than larger companies. Now, this is more extreme for something like investment, where stocks in the first size quintile are missing about 40% of their investment information, where stocks in the fifth investment quintile are missing only about 20%. But there's substantial dependency between the characteristics and the missing pattern. Now, which characteristic realizations are missing? So what I'm showing you here is the percentage of missing observations for a given characteristic broken down by the average value of that characteristic for the company when it's observed. So what we can see here for investment, for example, is that firms which are an average in the first investment quintile are missing their investment information about 50% of the time. That drops to about 20% of the time for characteristics which are, or for stocks which are on average in the third investment quintile. Again, it rises up to about 50% for stocks in the fifth investment quintile. The takeaway from this is that more extreme realizations, at least for investment, are more likely to be missing. Now, we see these U-shaped kind of patterns across many characteristics, almost uniformly. They may be more or less pronounced, but they are mostly observed. So this brings us to endogenous missingness. More extreme realizations are more likely to be missing. This is a challenging problem. Okay, so if I want to address these issues, I need a model for imputation, and that model needs to leverage some kind of dependency in the data. Now, the two kinds of dependency I'm going to leverage are going to be time series dependency and cross-sectional dependency. And we'll start with time series dependency. So what I'm showing you here, these are the average sample autocorrelations for each characteristic at the 1 and 12-month levels. What we can see is that many characteristics are highly persistent. For example, total assets or market equity, unsurprisingly, are very persistent characteristics. The takeaway from this is that if I'm going to perform imputation on missing values, and I have a previously observed value for that characteristic, I need to take that into account. There's also correlation or dependency in the cross-section. So what I'm showing you here are the parallelized correlations for characteristics averaged over time in stocks. The first observation from this is that there are very strong clusters of correlation. So if I observe one observation from one of these clusters, I should have a pretty good idea of what the other characteristics within that cluster should be. Secondly, there's a relatively complex dependency structure. So whatever model I'm going to choose should be able to learn that dependency structure without me having to specify it. And finally, there's a lot of dependency in between characteristics. So ideally, whatever model I choose will be able to leverage all the observed information that I have. Now, a natural model to exploit this sort of cluster structure in a covariance matrix is a latent factor model. And that's exactly what we're going to use. So this brings us to the modeling part. And just as a quick reminder, so what we're dealing with here is essentially a three-dimensional tensor, right? Like I have my characteristic dimension, I have my time series dimension, I have my cross-section. My goal is to estimate a low-dimensional model for the cross-sectional and time series dependency that I've shown you above. Just a technical remark, our baseline model is going to be using the centered rank quantiles for the characteristics. This gives us stationarity in the cross-section and over time and deals with outliers. If we want to move back to the raw values, there's a simple inversion via the empirical density. But we also show in the paper that our results are robust to alternative choices of standardization. Okay, so what I want to estimate, or what I want to get into first, is this model for capturing the dependency in that correlation matrix I was showing you earlier. So what I'm going to estimate is an approximate latent factor model for the characteristic dependency. So if I fix a point in time, what I have is a two-dimensional data set. So I want to estimate the characteristic factors corresponding to this data set. Now, if things were fully observed, a natural approach to this would be PCA. So I could look at the covariance matrix corresponding to my characteristics. I could estimate the eigenvectors corresponding to the largest eigenvalues, and those would be my characteristic factors. Now, because things are not fully observed, I can't use PCA directly. What we're going to use is this method from Zhao and Pelger, their Journal of Econometrics paper, which essentially performs a similar exercise on a missing or partially observed panel. So it's a two-step estimation process. So first we estimate the characteristic covariance matrix, where if we're considering two stocks, we only calculate the characteristic covariance between those two stocks using the characteristics which those two stocks share observed. So once we have that characteristic covariance matrix, we again estimate the factors as the eigenvectors corresponding to the largest eigenvalues. Now, once we have those characteristic factors, we can estimate the loadings via regression of the observed characteristics onto the characteristic factors. And that we do with this regression, which depends on this weighting WILT. Now, this is going to be 1 if characteristic L is observed for stock I at time t and 0 otherwise. What this does is it changes the regression to only take into account observed characteristics, but it also does some reweighting such that it accounts for a very general missing pattern. In fact, this estimation is shown to be consistent in this Journal of Econometrics paper under very general assumptions, namely that we can have dependency on time, stock, realizations of the characteristic factors, etc. So it's worth noting that the characteristic data itself is quite well described by a factor model. So what I'm showing you here on the left are the eigenvalues of the average characteristic covariance matrix averaged over time. And we see that between 4 and 9 eigenvalues are sufficient to explain the majority of the variation or the dependency in this characteristic covariance matrix. Now we choose 6 factors. We have an extensive study on this in the paper, but essentially what we find is that 6 factors is a robust and parsimonious model to give us good out-of-sample performance for imputation. So going forward, all the results I'll show you will be based on this 6-factor model. So now I want to add in the time series information. So the way I'm going to do that is I'm going to take those characteristic factors I estimated in the previous part, and I'm going to add in some previously observed value for the characteristic. I'm then going to estimate the regression parameters, this beta, using the same kind of weighted regression that I did to estimate the characteristic loadings. Now, naturally, I could add in more information. I could add in a future value. I'm going to call this model that only includes the past value the backwards cross-sectional model, because it's using backwards time series information and contemporaneous cross-sectional information. I'm going to call the model that uses future information the backwards forwards cross-sectional model. Naturally, I can have special cases, such as just a purely cross-sectional model and a purely time series model. Now, for each model that I'm going to estimate, I have 2 options for the data I use to fit the parameters. The first option is going to be a global model. So this is going to be one set of parameters for the entire time series. This has the advantage of giving me more data to fit over and should give me more precise parameter estimates. However, it's going to incur a look-ahead bias, and that's not going to be acceptable for certain downstream applications we would like to use this for. So we also have this local model where we only fit the parameters with the data at the particular point in time. This also has the advantage of giving us a time varying model. Okay, so now we'll come to the imputation part. So the metrics we're going to be interested in will be root mean squared error, or R squared, which is just a normalized version of root mean squared error. And we're going to be doing an out-of-sample evaluation. Now, the way we're going to do out-of-sample in this context is through a masking exercise. So we're going to take our panel of partially observed data, and we're going to mask certain entries. We're then going to fit our data on the subset of our models on the subset of data which was not masked. We can then impute the masked values and get an out-of-sample error estimate. Now we have in-sample results as well as using the masking completely at random, but we want a realistic kind of masking. So we go with 2 versions for that. The first is a block missing. So we observe empirically that data tends to be missing in blocks. So what we'll do is we'll randomly sample characteristics and then we'll mask them for 1 year at a time. The other option we have is using a logic model. So we fit a logistic regression model to capture the missing pattern in the data. And then we use that logistic regression model to mask entries and perform the masking exercise. Okay, so now these are the out-of-sample R squared results relative to the cross-sectional median for the block missing masking version. And what we see is the best models with no look-ahead bias is this local backwards cross-sectional model. The best model, which uses look-ahead bias, is going to be the global backwards forward cross-sectional model. Note, for both of these cases, we get a substantial improvement relative to current baselines, such as the industry or cross-sectional median or the previous value. Now, we get similar results if we do logic masking instead of block missing. And in the paper, we have an extremely extensive evaluation where we perform this same exercise and look at the metrics by type of missingness, so whether things are missing at the beginning, middle, or end, different masking strategies, over extreme quantiles, the size of companies, the industry over time, etc. The main takeaway is that our model performs pretty well. So just for a quick illustration of how this imputation performs, I'm going to look at three characteristics moving from very persistent to quite volatile. The company I'm going to be looking at in question is going to be Hasbro. And the way we're doing this is we're masking two one-year periods in 2010 and 2015. So these gray shaded regions indicate the regions where the data has been masked. The blue line indicates the ground truth or the true value of the characteristic during the masked period. The orange line indicates the observed value of the characteristic during the unmasked period. The black line is the model imputed data using our backwards cross-sectional model. The gray line is the backwards forward cross-sectional model, and then the green line is the cross-sectional median. And what you can see, at least from this characteristic, is that our model provides essentially a perfect predictor. Now, that's not that impressive because it's essentially the time series component gives you a perfect predictor a priori. But we can move to a more interesting characteristic like Tobin's Q. And we can see here that we're still doing a pretty good job out of sample, even though it's not as persistent of a characteristic. You can kind of also get an idea for what the model is doing, and that the backwards model essentially anchors at the last observed value, and then uses the cross-sectional information to capture the variation during the missing period. The backwards forward model has the advantage of being able to anchor at both points of the missing period. Finally, we look at a highly volatile characteristic, namely variance, and we see that still we're able to capture the out-of-sample variation. I think my laser pointer's not. We're able to capture the out-of-sample variation relatively well. And again, we see that if you're using the median imputation, you're not only getting the completely wrong level, but you're also getting zero of the variation during the missing periods. So what information is our model using? So what we're showing you now is the relative importance of the time series and the cross-sectional components in this prediction for each characteristic. We've ordered the characteristics in terms of increasing volatility, or decreasing volatility. So we have very volatile characteristics on the left, highly persistent characteristics on the right. And what we see is what you'd expect. For highly persistent characteristics, we're putting most of the weight on the time series component for our model. For very volatile characteristics, it's the contemporaneous cross-sectional information that matters the most. The main takeaway from this is that if you're going to have a model for imputation, you need to include both of these two data sets. Okay, so now we come to the asset pricing results. Remember, there's two fundamental effects that we want to study. The first will be the selection bias. The second will be the imputation bias. And we're going to start with the selection bias. So this is a very simple exercise to begin with. So I'm just showing you the mean return of a long-only portfolio that's value weighted for stocks which have a certain filter applied. So the black line, I'm showing you the portfolio performance where I allow the stocks everything that has a given characteristic observed. This is essentially just a market weight or evaluated market portfolio. Now the orange line are the stocks for which a given characteristic is not observed. We see that there are substantial differences in the average return between these two portfolios. This just illustrates that there is a complex interaction between the missingness and the return for given stocks, and it's captured and whether or not the characteristic is observed. So now I'm actually going to fit an asset pricing model. So what I'm going to do here is I'm going to first take my fully observed subset of data, and I'm going to fit a conditional asset pricing model, namely the IPCA model from Pelger, Pruitt, and Su. I'm then going to impute the missing values in my data set using my backwards cross-sectional model, and then I'm going to refit the IPCA model. Once I have those two model fits, I can form the implied SDFs and compare the Sharpe ratios of those two SDFs. I can look in and out of sample. I'm going to use the first half of the data set to be the in-sample data set, the second half to be out of sample. And what we see is that there's a substantial difference in Sharpe ratios, including including stocks which had missing observation. So the orange line is using only the fully observed subset of the data. The blue line is using all the data with missing values imputed. And again, the takeaway from this would be that an investment strategy, which is only going to use the fully observed subset of the data, is going to be suboptimal. Now, this also affects very simple portfolio sorting exercises. So what I'm doing here is I'm constructing decile sorted portfolios and looking at the performance of the top and bottom deciles. I'm going to look at the Sharpe ratio, the mean return, and the volatility for these portfolios. Now, what I'm going to do is I'm going to require more and more characteristics to be observed for a stock to be included in the portfolio. Now, I'm going to form breakpoints for these portfolios based on the New York Stock Exchange breakpoints, which is very standard. And at first, I'm just going to require that my sorting characteristic, in this case, book to market, is observed. But next, I'm also going to require that we observe stocks, net investment, cash flow price, and so on and so forth, until at the end, I'm going to require that all characteristics are observed. There are a few things to note. So first, the risk premium for these portfolios gets quite distorted as we require more and more characteristics to be observed. But interestingly, the volatility for these portfolios does not behave exactly as you'd expect. So for the smaller portfolio, the volatility actually decreases as we require more and more characteristics to be observed. This again shows the complex interaction between returns and characteristics. Now, this observation is not unique to book to market. So we also see the same exact pattern if we look at operating profitability. Namely, we have substantially affected mean return, and the volatility for the small leg of the portfolio does not uniformly decrease, or sorry, does not increase as we reduce the number of stocks. Okay, so now let's get to the imputation bias part. So the application I'm going to look at here is estimating the risk premium. And the way I'm going to do that is I'm going to form characteristic managed portfolio, pure play portfolios by regressing returns on my characteristics. Now, I want to compare the results I get with backwards cross-sectional imputation versus median imputation. And naturally, I'll get different numbers. But I want to make a statement about accuracy. So I'm going to do this masking exercise again. So I'm first going to take my fully observed subset of data, run these cross-sectional regressions, get my portfolios, get my risk premium. I'm then going to mask a subset of that data using my logistic regression model. Then I'm going to impute that masked data using either the cross-sectional regression or cross-sectional median or the backward cross-sectional model, rerun these regressions and look at the errors compared to the baseline I have from the first cross-sectional regression. What we see is that the imputation or the risk premium we get from the backwards cross-sectional imputation is almost uniformly closer to the true baseline than the median imputation. More importantly, though, we can get substantial risk premium errors if we impute things using the cross-sectional median. Now, this is just the mean of these pure play portfolios. I can also look at the correlation between my portfolios that I have based on imputation and the ground truth portfolios. And what we see here is that the portfolios based on the imputation with our model almost perfectly correlated with the portfolios we had with the unmasked data. That's not the case for median imputation. So if you're using median imputation, you're not only getting the wrong mean return, you're getting the wrong variance for your portfolios, you're getting the wrong standard deviation, you're getting the wrong t-statistic. So to get an idea of what we're looking at, so the blue line in these plots is going to be the true value of the characteristic managed portfolio for a few example characteristics, namely book to market, investment, and sales to price. What we note is that the portfolio is based on our imputed data, the orange line, tracks the ground truth portfolios almost exactly. However, the median, if you use median imputation, you can get severely distorted portfolio returns. Now, interestingly, we never mask market equity in our analysis. It's always observed. But we're running these cross-sectional regressions, and characteristics are correlated. So if I'm wrong with some of the values that I'm putting in for other characteristics, that's going to distort risk premium estimates or the returns of these pure play portfolios, not only for the characteristics which were missing values, but for any of them which were correlated with those. Okay. So again, we presented today a systematic study of missing data and characteristics. Again, the problem is pervasive and affects even simple investment strategies. There's a complex and endogenous pattern to the missingness, and simple solutions, such as the cross-sectional median, don't work. We've also provided a novel method to impute these missing characteristics. It's a parsimonious model for the characteristic structure, and it captures the time series and cross-sectional dependence. Importantly, it's also valid under a wide range of dependency patterns between the missingness and the characteristic realization. Looking forward, as the usage of big data and machine learning increases, missing data is going to become more and more of a problem. And so thinking about solutions to this kind of challenge matters. Furthermore, there are many new exciting data sets, such as ESG data, international data, where the missingness is even more prevalent. And we think our model has applications there as well. So thank you very much for your time, and I look forward to the discussion.
Thank you. So discussion is Lingxiao and Peking University HSBC School.
So hello everyone, thanks for being here, and I'm very glad you have so many people here, although it's very late. So I'm relatively to be not that too complex, because I think this is really a well-established complete paper. When I read the paper over 100 pages, and there are a lot of details there, and I personally learned a lot. So I like this paper a lot. And so I summarized a little bit. So actually, in my point of view, I like it because firm characteristics, they are like the basic blocks. We are building a very huge beautiful asset pricing, and those characteristics are just basic blocks. So they're very important. In the first page, I kind of realized we are talking about some similar stuff. They have been long used to construct anomalies and testing portfolios. Even in my personal research, I use them a lot. So when as an asset pricing field, many times we are using the somehow like macro level data, so the portfolio level. So we do know there are some mismatches for the characteristics, but we just use the portfolio and pretending they're not exist. Not like pretending, but we do not pay very high attention there. So kind of, in my point of view, I agree that the macro foundation, which is the firm characteristics, the mismatch issue is underexplored. So in this paper, given so many details, they provide a very comprehensive analysis showing that the missing data issue is pervasive and widespread among majority of firms. So the methodological contribution is that actually for most of the traditional approaches, we either drop the data or we just use some market or industry median. But by showing also comprehensive analysis, I also learned that the data is not missing completely at random. So as a novel approach, this paper provides an imitation approach. They consider two parts of information. First is the cross-sectional information, and second is also the time series dependency. So in terms of two aspects, to deal with the cross-sectional dependency, they use the novel approach from Zhao and Pelger. But to my point, I kind of think it shares some similarity with the PCM. So it kind of like a latent factor model. So I try to understand it as a PCA. It helps me to understand. When it goes to time series dependency, they use two models. The first is the backward looking only model, and the second one is the backward forward looking only. And they also mentioned in one of the subsections that there is a trade-off. Trade-off between that, the more information you use, so you need to use the forward data that will improve your estimation precision, but there is a forward-looking bias. And they also compare their performance with the traditional approach. And I'm impressed to see that in the paper, there's one session. So all the data they are using as the ranking data. So they also discussed a little bit that if you use the raw data, maybe it's not perform as well as the ranking data. And I'm a little bit curious why that happened, but I'm glad that I want to give my comments as the author and knows the issue in the paper. So I have two major comments. Instead of calling out comments, I prefer to label it like open questions for the potential, say, for me to think about. So in this approach, they use a latent fact model. But recently, there is a paper from Jensen, Kelly, and Peterson. Many of you might read that. Is there a financial crisis in finance? So I'm kind of thinking, is there any alternative to the latent fact model? So the latent fact model is like a principal component analysis, but the characteristic, it do have some economic meaning. So in that paper, they have 153 characteristics, and they kind of sorted into 13 categories somehow. So I'm not saying this, I like this approach, but I'm personally thinking, is there any alternative? Maybe some free economic grouping might help, because those characteristics, some are related to momentum, some are related to value. So themselves, they have some economic model that we can have some sorting in the balance, or we may have some hierarchy model that can help us better estimate the cross sectional dependency, because each firms, they're unique, but they are somehow, some of them are in the same industry, they are also exposed to the systematic risk. So somehow, maybe by giving it some hierarchy model or some sorting that can deal with the cross dependency in another approach. So that is the alternative I have in my mind. So that is the data set they have in their paper. So that might be, I think, interesting to think about. That question I have in mind. So the paper do have a lot of asset pricing implications. But for me, okay, so I now understand that the macro foundation is changed a lot by using the novel approach. So I'm curious to see how much that will affect the macro level. That if you do the aggregating, if the factors is recalculated using the new macro data, well, the three-factor model still pricing the portfolios. Or if we have some new factors, not new, the same factor, but constructed using the new characteristics imputed, will that improve the asset pricing model performance in terms of individual stocks? Because we all know individual stock pricing is very challenging. And so here, now if more and more data, more precise, will that micro foundation improvement finally alter the tone of the macro level? That sometimes I find that market somehow is very good, because adding a lot of factors doesn't change the individual level that much. Maybe when the factors are re-estimated, that can improve the asset price performance. I hope that could happen. So to conclude, I like this paper a lot. This is a very important paper concerning the linking data, financial data issue, and in my point of view, it fills the gap between the macro and micro level of the asset pricing, and the comprehensive analysis of features, patterns are included, and there is a very novel approach to include the business data using both professional and time series information, and that absolutely outperforms the traditional approach. So thank you for the paper.
Thank you, Zhao. You want to respond quickly?
I think, can I have a little bit of color to maybe the first question in that we've thought a little bit about, kind of alternatives to the latent factor approach. And I think one of the things that's been suggested previously that is an interesting idea is something like k-nearest neighbors, which is very much using a non-latent structure to the characteristic dependency. One of the reasons we like the factor approach is because we have these consistency guarantees, even in the presence of missing data, which k-nearest neighbor is going to be some sort of like EM style algorithm, which isn't necessarily going to converge to the global optimum. And so it's a little bit trickier to use something like that as opposed to something where we have guarantees. But it is an interesting point, and we have been meaning to test out how the performance of something like that works in comparison to our model. And then I think that the second question, I don't think we'd see, so to be honest with you, if we're just looking at like something like size, book to market, and value, like the Palmer-French three-factor model, I don't think you would see a huge change in the performance of that model if you were to impute all the missing values, purely because size is almost never missing, value is quite widely observed, and so is book to market. So it's three of the most widely observed characteristics, partially because if you look into how those are constructed, there's like a litany of like fallbacks to construct book to market, or if some component of the data is missing. So I think for those particular models, we wouldn't see that much of an improvement. It's really when we have these models like IPCA, where we require a large number of these characteristics or covariates to be observed to fit the model, that we see this large improvement from including the imputed data.
Any other questions? Yes.
Excellent presentation. I forgot if I asked, but on the same question last time I did. Is how, so we know that, so I also see you try to supply to compare with like industry median or the implication error there.
Yeah.
And one thing we know why people only use the mean or median, because when they construct factors, they focus on the long and the long and short lag. Both and most of them, they and median, they don't show up on both legs. So one thing I'm quite curious that is when we into the data set, how many of these stocks might show up in the long and short leg, and that might improve the factor performance.
Yeah, so again, it's going to depend on which characteristic we're looking at. We certainly see that when we do this imputation, we can like get higher Sharpe ratios for some of these factors in like long short legs, if we're considering like a zero cost portfolio. The reason we don't really include that is because it's relatively hard to make a statement about the accuracy of that, because there's no baseline we can compare it to. But we definitely see that when we do this imputation, we can get stocks showing up in either one of these two legs that would matter for the factor construction. But again, for like the standard Palmer-French 3 or 5 factors, we won't see too much of that just because there's not a lot of the missing data for those.
So quick question is, you use a consensus dependency.
Yep.
How you impute the data? You implicitly assuming there is no data. So maybe you like when you mentioned local model, we say, are you allowing the correlation between your
So
I
believe we have the results in the paper. I don't have them in the presentation, but if we look at the so you can have a measure of essentially like a generalized correlation between factor loadings and look at this over time. So what we can do is look at the character or the generalized correlation between the loadings for our characteristic factors. If we fit them month by month over time, what we see is they're extremely stable actually. So there is this sort of global structure to at least the loadings for the characteristic factors. So we're not like, yes, when we do the global fit, we are making that implicit assumption that the loadings in our model are stable over time, but we see that very much fits with the data that we observe.
the difficult challenge for me when firms are going through market change. For example, if they merge with another company, then probably I'm not saying
Yes, yeah.
But the verb is not the verb.
I
have a uncertainty for and rely on.
Yeah, that's a very valid point. So I'd say on aggregate, it's very stable on a per firm basis. there are certainly shots and idiosyncrasies where they're not perfectly captured by us.
I feel like that's really quick because the method is actually work. By the way, I know we have best paper and best instruction for work coming up. I just realized this paper really something for ICDM and paper work. And I did that in my university. We have like 7, 8 people on that committee, and this brings the best prize last year. And even announced the winner for this year, today, or at the meeting, that you need to pay like $20,000 to attend our event, because it's mostly for international training part. And there are just a few researchers presenting, right? So we did this last paper and do other stuff. So congratulations.
Thank you very
I
much.
don't know whether this issue includes you. Yeah. But anyway, I was still learning. You were using very standard method. Yes, regression data method. We can say weighting factors or whatever. But sometimes you don't really need to impute the exact numbers for we can calculate it. I just need to know, for example, whether they're, top 10%, bottom 10%, something like that.
Yeah.
I kind of wonder, is actually not, what if you use some machine learning tool and computation? I don't know. You guys know this more. Instead of me, figure out the dependency and this characteristic, common factor, right, in characteristic, but just some other machine learning tools. So we're not thinking about the dependency and somehow compute how input it is. But in terms of categories, like the characteristics of a particular firm, very highly low.
Yeah, so I think I don't know too much of like a classification example about this kind of model using machine learning model. I have looked at using essentially neural networks to perform the task of our characteristic dependency. And if you can get it to work, basically it's not a little bit better, but you lose any of the guarantees that you have as far as consistency, and you lose the parsimony that you have in this model as well. And the gain that you get from doing this kind of larger model is not actually very consistent. Furthermore, if you want to do things correctly and like actually account for the missing patterns, what you need to do is some sort of like product weighting on your training sample when you're training this complex model. And as I think what you mentioned earlier today, we're going to end up with very unstable training procedures when we're doing this sort of inverse propensity weighting. And so that doesn't actually work well at all in practice. Yeah.
Interesting outline. Normal cases is AI useful. You don't get in this case, but the characteristic happen is very stable and common type of software. How you guys help everyone.
Yeah,
We can get it. Right?
we can end the conference by saying the linear regression is still too high.
It's big data. Any other questions for our last speaker?
Our group, I'm trying to learn actually, and I recommend to here and you may know average has another paper also talking about mean value stuff. You both paper address the same question, but you have a different conclusion. From Andrew paper, they argue that just use the cross-sectional median or use the algorithm, mean values seem not play a role at all. So I'm quite curious what happened.
So I'm not sure exactly why. So I know that like the EM algorithm does have some very structural similarities to the kind of algorithm that we're using. So you can think of EM as like almost a matrix factorization kind of algorithm.
Yes, but this paper that concludes that it doesn't matter.
So I think it will depend on what you say as far as like how do you decide if things matter. So for these cross-sectional regressions, right, like what we've shown is that like your parameters in particular are going to be distorted. And that may be a different conclusion than you reach if you said, okay, I want to care about return predictions using some sort of fancy machine learning model. But I think when you phrase it in terms of like, what is your objective for deciding whether or not something is missing that matters, you can get different conclusions. Now, obviously, we think that at least the criteria we set out here is a reasonable thing for deciding whether or not missing matters, but other people may have other opinions.
Okay, thank you.